Welcome to the Biotech Capital Compass, the inaugural October 2024 edition from Tecumseh Partners, authored by Hartaj Singh, a 30-year veteran of drug development and biotech investing. The newsletter is built for three types of readers: active investors, swing traders, and anyone genuinely passionate about the biotech space, each getting insights tailored to how they invest. The Q4 2024 outlook for biotech looks promising, driven by three key catalysts: major healthcare conferences in San Francisco, a pickup in M&A activity, and the potential tailwind from falling interest rates. October's seasonal weakness is actually seen as a buying opportunity, with the recommendation to build positions across three biotech ETFs, IBB, XBI, and BBC, ahead of an expected rally through early 2025. Gilead Sciences stands out as a top pick, backed by a strong HIV pipeline, a growing oncology portfolio, and one of the highest dividend yields in the entire biotech sector. A recent meeting with Biomea Fusion Management revealed real excitement around BMF 650, their third clinical candidate, set to be introduced October 30, alongside Q4 updates on the covalent diabetes trials. Now let's look at how the NASDAQ Biotechnology Index behaves across the calendar year, because the seasonal patterns here are surprisingly consistent. This heat map of monthly NBI index returns from 2014 to 2024 makes the seasonal story clear. September and October are reliably red, while November through January light up green year after year. In U.S. presidential election years, the contrast is striking. The NBI averaged a negative 7.5% in October, then flipped to a positive 3.7% in November, a sharp post-election recovery. The one exception was 2008, when the financial crisis pushed the index down a combined 20.4% across October and November. But even then, it bounced back sharply, with an 8.3% gain in December. Two structural forces explain why biotech tends to perform so well from November through January: a wave of major healthcare conferences and a surge in M&A and licensing deals. The cluster of San Francisco conferences each January, J.P. Morgan Healthcare, the Biotech Showcase, and the Digital Medicine and Med Tech Showcase, collectively spark some of the biggest deals, partnerships, and investment momentum of the entire year. The second driver is M&A and licensing activity, though it's worth noting that 2024's third quarter has been unusually quiet on that front. This dashboard shows biotech M&A deal volume from 2014 to 2024, with a clear peak around 2020 and 2021, followed by a steady decline. 2024 volume is currently running about 32% below last year, highlighting just how slow things have been. The contrast between eras is stark. 2020 and 2021 were defined by easy money and speculative early-stage deals, while 2024 has shifted to fewer, larger, late-stage transactions, with a notable focus on CNS, reflecting a far more cautious market. Now let's look at how the two presidential candidates' policy platforms could pull biotech stocks in very different directions heading into November. A Harris win could expand the Inflation Reduction Act, squeezing companies like Regeneron and Gilead on Medicare pricing, while a Trump win would likely ease that pressure and open the door to more M&A through lighter antitrust enforcement. Despite those contrasting scenarios, Wall Street analysts are broadly neutral on the net impact of either party, and the final shape of the Senate and Congress will matter just as much as who wins the White House. Interest rates have a real and direct effect on biotech valuations, and for smaller, cash-burning companies, the direction of rates can make or break their funding environment. Lower rates work through three channels at once. They reduce the cost of capital, lower the discount rates used to value future cash flows, and make it easier for smaller biotech firms to access venture capital and equity funding. When rates rise, capital flows out of growth-oriented biotech and into safer assets like bonds. But when rates fall, that dynamic reverses, lifting sentiment and funding conditions, especially for smaller companies. With the seasonal setup in place, here's how the newsletter recommends positioning across biotech ETFs to capture the anticipated rally from November 2024 into early 2025. The suggested allocation is 50% in IBB for large cap exposure, 30% in XBI for small and mid caps, and 20% in BBC for smart beta, illustrated with a simple $1,000 example of $500, $300, and $200. This ETF strategy is designed to capture several upcoming catalysts at once: large cap Q3 earnings in November, San Francisco investor meetings, and any recovery in M&A and licensing activity heading into 2025. Now let's take a closer look at Gilead Sciences, the newsletter's featured stock pick, covering everything from its history and financials to its pipeline and analyst sentiment. Gilead's story follows a clear arc. Founded in 1987, it built its reputation through HIV and hepatitis C breakthroughs, stepped up during COVID-19, and is now pushing hard into oncology and immunology. Gilead's financials show a steady and improving picture, revenue growing from $27.1 billion in 2023 toward nearly $29.8 billion by 2027. Gross margins holding near 78%, and free cash flow climbing above $10 billion by 2026, with adjusted EPS recovering after a 2024 dip. The Inflation Reduction Act poses a real near-term risk to Gilead, with its top HIV drug Biktarvy and hepatitis C treatment Epclusa, both exposed to Medicare price negotiations, though the newsletter argues this concern is already priced into Gilead's below-peer valuation. Three engines are expected to drive Gilead's 2025 growth: its dominant HIV portfolio, led by Biktarvy, and PrEP, a fast-growing oncology franchise with Yescarta and Trodelvy, and the newly acquired seladelpar for the autoimmune liver disease primary biliary cholangitis. This three-year chart tells a clear story. When Gilead's 2025 and 2028 EPS estimates dropped, the share price followed. And when estimates started rising again in the second half of 2024, the stock responded positively, making forward earnings revisions the single most important share price driver to watch. Lenacapavir could be a genuine game changer, a twice-yearly injectable for HIV prevention that dramatically improves compliance over daily pills, works against drug-resistant HIV, and could expand the U.S. PrEP market well beyond its current 400,000 users. Gilead's oncology business is now contributing roughly 50% of its current growth, with Yescarta CAR-T, Trodelvy for breast and other cancers, and its broader cell therapy platform all positioned as major commercial drivers over the next decade. Here's an interesting tension. Oncology is only 12% of Gilead's revenue today, yet it's already the company's most critical growth engine, with Gilead estimating just 1 in 5 eligible patients currently receiving its CAR-T therapies. Gilead rounds out its investment case with a 3 to 4% dividend yield, an annual dividend of around $3 per share, and an active share buyback program, rare features for a large-cap biotech that appeal to both growth and income investors. Analyst sentiment has shifted meaningfully in Gilead's favor. 30% of covering analysts have turned more positive over the past 6 months. 35% have raised their price targets in the last month alone, and not a single analyst has cut their target during that period. Before wrapping up, the newsletter covers the key regulatory and legal disclosures, including risk warnings, conflict of interest policies, and trading blackout rules. 3 standard but important reminders. This newsletter is informational only and not investment advice. Past performance doesn't guarantee future results, and biotech investing carries real and significant risk of loss. Full transparency. The author holds personal positions in Gilead, Biomea Fusion, and the XBI, IBB, and BBC ETFs. And a trading blackout period applies to all securities mentioned, both before and after each publication.